Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're speaking with Anu Ganti, CFA. She is a Senior Director of Index Investment Strategy at S&P Dow Jones Indices. Prior, Anu was an emerging market equities portfolio manager at Parametric Portfolio Associates and completed her post-MBA rotational program at Russell Investments. Anu is a CFA charter holder and holds an MBA in Finance and Economics from Columbia Business School and a bachelor's degree in Finance and Marketing from NYU Stern. So, Anu, thank you for being here.
Absolutely. It's so nice to be here, Rob.
So I did spend a little bit of time on your website in my prep for this, and I found some really interesting videos, some great papers, all things that I would recommend CFA Society New York members go check out. One thing I did want to ask you right off the bat about, because we've had so many things change in the last couple of weeks, is this concept of energy's impact as a diversifier against volatility. What are you all seeing?
Yeah, so it's interesting if you look at our research, because last year was a very challenging year, right? We saw losses across equities. We saw losses across fixed income. There were really few places to hide with the exception of commodities. And you mentioned energy, which is one of the shining spots that we saw last year. And if you look at it from a volatility perspective, we actually saw that energy was one of the top most volatile sectors. So intuitively, you would think it's a volatile sector, right? How do I think about it from a diversification perspective? But what we noticed, if you dig down, is you look at energy's relationship versus the remaining sectors. And actually, if you look at the rest of the market, we have an S&P 500 X energy index. Mm-hmm. And if you look at that relationship between energy versus the X energy, the rest of the market, those correlations were actually declining last year. Right. So if you think about it from a diversification perspective, energy was actually acting as a diversifier, which is sort of counterintuitive if you think about it, because it was one of the most volatile sectors. So that's interesting to watch. And what I would add to that is it always changes through time. So if you think back to the tech bubble, for example, if you think back to the financial crisis, the defensive nature of sectors is not static, which is why it's important to pay attention to the correlations of these sectors. And you talked about energy. You can do the same thing with technology, for example, because we saw that technology was acting as a volatility enhancer. Right. And then you can look back to the tech bubble. So it's fascinating to see this relationship between sectors and how they change over time, because especially as we go through the gig sector change, constituents moving in and out, their characteristics change. So it's been really interesting to watch energy.
Yeah, this is an exceptionally interesting time because, one of the things they teach us in school is that when stocks go up, bonds go down and vice versa. But of course, stocks and bonds had approaching one correlation in the last year. And that made there's a lot of question about does the mix actually work? Should it be 70-30 or the other difficulties that come along with that? So I wonder if in your research, did you look back and find another time when stock and bond correlation reached or approached one?
Yeah, so historically, we've looked at equity versus bond correlations. And over the long term, you're right. You tend to see that negative correlation, which is good from a diversification vantage point. But last year, as you mentioned, right, we saw losses across the board, and then we saw that positive correlation. So it's interesting to think about this relationship. And if you look at it right now, when we're speaking in the time of this podcast, we've seen the negative correlations come back again. So that positive correlations have flipped negative again, which could bode well for a diversification perspective. So absolutely, I think it's important to look at it from the equities framework, to look at it versus equities versus bonds, and then thinking about the nature of bonds in the portfolio, and looking at it from an index perspective is very interesting because we look at it through history, like you said, looking at, for example, the financial crisis, for example, the tech bubble right now with the external shocks that we're seeing within the financial sector, within the banking space. And you've seen that flight to quality come back with yields, especially 2-year yields, declining. So now we've seen those correlations come back down again. So that's something that we'll be watching. That'll be an indicator that we'll definitely be watching to see if it continues through 2023, because that'll be an important impact for asset allocators.
Yeah, and I'm glad you mentioned this because this is an important framing. We are recording this nigh on the end of the first quarter of 2023, just in case someone downloads this 6 months from now and things have changed. So the quality issue has become a big one right now. And, one of the things I noticed that you all have made a statement about is sort of taking a temperature of technology as a higher quality sector due to some of the things that have happened so far. So could you talk a little bit about that, please?
Yeah, so I'm glad you brought up technology because, I blogged about this before, and it's one of my favorite topics to talk about, visualizing the factor exposures through sectors and vice versa, because they have a very symbiotic relationship. And to give you, an example using technology has a strong tilt towards quality, right? But it wasn't always the case. So if we look back to the period of the tech bubble and the bust, then technology was much more volatile, and it didn't have that quality, that strong quality tilt relative to the S&P 500. So, the name of the blog was Not Your Father's Tech Sector, right? So it was a very different world back then. So I think that just goes back to the point about how sectors evolve over time. So if you're thinking about technology from 30 years ago, it's very different today because you have those more robust fundamental companies. Think about those strong profitability screens. You have a stronger quality tilt right now. And we also had the gigs change with our communication services sector that started a couple of years ago. So that is something to think about because you can also flip it the other way and look at our factor indices and look at the sector tilts associated with our factor indices. So, for example, we have a quality index, and technology has a big exposure in that index. So it's interesting to see the layers. And what I always like to say is you can't think about them in silos, right? If you're looking at sectors, it's important to understand, am I getting a quality tilt? Am I getting a tilt towards low volatility? Am I getting momentum? Am I getting high beta, for example? And then the other way around, if I'm looking at factor exposures, if you're building a factor portfolio or an index, what kind of sector tilts are we getting? Are we overexposed to technology? Are we exposed to financials? And then paying attention to the rebalance because things change in the market. Things change with the reconstitution, with the rebalances. So it's interesting because they have a very intertwined relationship, sectors and factors.
Yeah, I mean, setting an asset allocation and rebalancing an asset allocation are two of the thorniest things. They're not, everyone sort of thinks, so I got my allocation set, I go to sleep now. Deciding what are reasonable reallocation bands and what you trim and what you don't is exceptionally difficult also. But you talked a little bit about factor exposures, and this is actually my favorite thing on your series and your blog. This is a paper I recommend all CFA New York members check out. What is changing in the nature of factor exposures outside of the tech one that you just mentioned?
Yeah, so, we talked about technology, we talked about quality. I think another timely one right now in the market that's important to pay attention to is low volatility, right? When you think about different regimes, you frequently hear in the market, it's a risk-on environment or it's a risk-off environment. And right now we're in that risk-off environment where people are nervous, investors are seeking quality right now and that robust fundamentals. We've seen low volatility outperform and we saw that last year. We saw that in the US as a sign of defense. So that's one of the interesting ones to think about. When we think about factors, you can, sort of break them into two buckets, right? Risk enhancers, and then risk mitigators. And I always like to say that you don't have to think about them as separate factors. You can also think about combining factors. Right. And when you think about combining factors, you're thinking about what kind of correlations do these factors have associated with each other? Because typically if they have lower correlations, right, and they have less of an overlap, they could potentially work historically. We've seen, you get historically a higher efficient frontier and a higher risk-adjusted return than just having one single factor.
Right. Could you talk a little bit more about that? Because that was one of the things I thought was really cool in your paper.
Yeah.
Was talking about the historical examples of that. Could you give us some other ones, please?
No, absolutely. So, we've talked about low volatility, for example. Another one of my favorites is just looking at our equal weight index, right? Yeah. And equal weight it's so simple to explain because you have, the S&P 500 equal weight. Everything is equal weighted, but it's fascinating to look under the hood at the factor tilts of this index. And to give you an example, our equal weight index has a tilt towards small size,
Mhm.
for example, which makes sense because
Yeah.
you have less exposure to the mega caps.
Right.
You also have some tilt towards volatility, for example. So it's interesting to see the factor tilts of equal weight, and they change over time as well. So I think it's a good example of thinking about risk mitigators versus risk enhancers and combining those, because historically we've done some studies on this, and you can really see the curve. When you plot out the efficient frontier, you're getting that higher risk adjusted return. But like I said before, the factors are going to change over time too, the factor indices. So it's important to pay attention to, the rebalances and what's going in, what's going out. How do the sector tilts change through time?
Yeah, that is so once again, I really recommend everyone take a read of that. I'm going to put a link to that in the show notes for this event. So if anyone's listening to this on their phone or on their computer at home, you can just go over to cfany.org and look up podcast page, and you'll be able to find a newspaper there. Totally worth reading. And thank you for being here.
Absolutely. Thank you so much.
And thank you to all the CFA Society New York members who've been listening. Our next podcast is just around the corner in 1 week's time. Until then, I'm Rob Rowan, your host.